Hi, everyone. I'm Rick Bensignor. Welcome to this week's In the Know Trader Show. Today is Tuesday, June 22nd. This week's lineup in our trader education portion, we're going to talk about, so you want to trade meme stocks, talk about how to trade them. Our market overview, we'll take a look at the QQQs, that's the NASDAQ 100 tracking ETF, the TNX that tracks the US 10-year Treasury, IVW divided by IVE, that's a ratio chart of S&P growth versus S&P value. And then we'll take a look at the XLE, which continues to be this year's best performing macro sector, and take a look at what it looks like with crude oil having passed over $73 a barrel this morning. And that, of course, is a new high on the move. And in our sector analysis portion, let's take a look at the meme stocks. So we've got about a dozen here that we'll try to get through as many of these as possible. These are some of the bigger names that get associated to this whole meme phenomena. So we'll take a look and hopefully help you out here on some of these stocks that you may have as part of what you're doing trading wise. To sign up to get my weekly ETF tactical trading report, we call it the TTR, comes out Thursday nights. Go to intheknowtrader.com. That reviews all the macro markets, gives you new ETF trading idea each week, and then goes over every open position we have from prior weeks until we close them out. We update sell stops, targets, etc. And that's what that report does. It's had a really good year. And then, of course, we started last August 1st, the 7-Eleven monthly spider sector ETF report. This is for those who are looking to beat the S&P, certainly those who are money managers, those of you who are in financial consultants and managing other people's money. One of the best things you can do for them is beat the S&P. We are currently doing that 10 months into our first year. We are outperforming the S&P by 341 basis points. That's 3.41%. That is golden if you are in the money management field, and if you are an FA, a financial advisor, anybody who is managing other people's money, I strongly suggest you take a look into this report. It's less than $100 a month. In fact, I think it's $87. And if you can beat the S&P, you are a hero to your clients. My email address, rick@intheknowtrader.com, and that takes care of that stuff. Let's quickly take a look at S&P macro sectors. You can see the S&P, the spiders are up 13.3% on the year. 4 times that return, or well, 3.5 times that return is energy at 45.65. It is the number one performing sector this year. As I said, I think throughout the entire year it will remain the best performing sector. Real estate has now slid into the number 2 position, up just about 25%. Edging out financial is up 23%. And then, of course, you got communication services at 17.79. And of course, not a surprise on a year that the market's up again, despite the fact that, we're kind of stalling here over some time. Staples only up 3.73 and utilities up 4.33. The big laggards there. And you've got a bunch that are not far from the S&P. So it's typical year, you've got a couple of big winners, a couple of big losers, and then everything else somewhat near. All right, so let's start off trader education. You want to trade meme stocks. You see them talked about on StockCharts, on CNBC, in the Wall Street Journal, wherever you turn, there's a headline about meme stocks. And the biggest ones have been GameStop and AMC, the theater chain. Other ones have crept in, but those are the 2 biggest ones that have had some phenomenal moves relative to what their true implied value is. And the thing is, and I suspect you know this if you're already currently trading them, for those of you who are tempted to dip your toes into this type of speculative arena, certainly it is most important to know that any given day you could easily lose 20 or 30%. That's how much these stocks can move. One of the stocks that I've been looking at is down 30% this week. Um, and these are complete crapshoots. And look, if you were in GameStop from when it first became highly talked about, you're doing fine. If you're in AMC when it first really became a meme stock, you're doing great. But you also saw some massive drawdowns. So it also depends upon when you got into these. That's going to have to do with if you're up money or begging to get your money back, and then possibly promising yourself that if you get your money back, you'll never trade one of these meme stocks again. And I'll put it in the category of trying to trade Bitcoin or Ethereum or the cryptos. If you catch it right, you can do really well and make multiple times your investment. You catch it wrong, you can lose significant amounts. Bitcoin's down 50% in I'm trying to think here. Is it probably I don't know, a month or two? Maybe it's 3 months, but we topped at 64,000, and today we're down playing with and tucking under 30,000. So if you're long at 3,000, you're still making a killing, but you've given up a huge amount of gains. These are not for the faint-hearted. And if you want to play GameStop, AMC, or any of these other names, just realize that these things can fall apart anytime for any reason, because they don't trade at theoretical value, if you can even create a theoretical value. I just saw Tom Lee on CNBC, and they showed a clip from earlier this year where he said he thought Bitcoin could end the year at 100,000, or that we would see $100,000 per Bitcoin this year. And they used that as the teaser to then interview him live. And Tom was actually sitting in his car, parked, a nice green background, so probably somewhere in the suburbs, or who knows, out on vacation, whatever it is. And the CNBC anchor addressed, Tom, do you still think Bitcoin can go to 100,000 this year? And they kind of said it half kidding because it's trading at 30 now. And his answer was yes. So look, there are confirmed bulls in these markets who, regardless of kind of what's going on at any given time, are still going to believe in the story that they believe in. And that may mean that AMC could go to $100 a share. It might mean Blackberry, which we'll take a look at, can go to 30, 40, or $50 a share. Some people think it, but generally it's not the fundamentals that are pushing this. And we've seen that if you look at GameStop, which started as about a $10 stock that shot up to $400 without having any major change in fundamentals, you know what type of speculation you're dealing with. So if you're going to trade these meme stocks, and we'll get to them in a few minutes, realize what you're playing with. You are playing with something that is way beyond value, that you're buying based on the greater fool theory, which means that you're buying with the hope that some other person is going to pay more than you to push the price higher, and that phenomena will keep going, and that you'll be smart enough, and this is the flip side of the coin too, that you'll be smart enough to figure out when to get out before the stock collapses. And if you look at Bitcoin falling from 64,000 to 30,000, if you got in on at 45,000 and didn't get out at 64, and then held on saying, okay, it fell to 55, it fell to 50, I'm still up some money, I'm going to wait for it to make new highs, like I hear so many people saying, well, now you're holding a significant loss. That's what you get when you play these names. So understand thoroughly that that's the game you're playing. And if If you don't have the ability and the wherewithal to lose the entire investment, 100% of the investment, you have to, in theory, be able to lose and it not affect your life whatsoever, not affect your buying a house, buying a car, sending your kids to college, paying your mortgage, paying your food bills, paying your cell phone bill, then you should not be playing these stocks or the cryptos, because you have the potentiality to lose everything. And you just have to know that going in. So if you're living paycheck to paycheck, you don't play these names and you don't play cryptos. And if things are financially tough and you're in debt, you don't play them. And unless you can afford to lose all the money and it have no effect on your life, you don't play them. Okay, let's move to our major kind of macro type stuff. So we'll start off with the Qs when we go to our charts here. Here's a weekly chart of QQQ. Can't help but notice, and let's make it nice and clear, this 13 that we're staring at, you know that this, for those of you who have followed me, you know this is a model developed by Tom DeMark, a very noted technician. He built this model, or better said, designed it back in the 1970s. It looks for an exhaustion point to a move, or another way of talking about it is in this case, in something that's been moving up, a bad time to be a buyer in an up move. So generally you can buy at better levels when these signals show up. If we go back to 2019, I'm gonna blow this up a bit because we're gonna see that both, actually in 2018, not far from what was the all-time high, we had a decline, a significant decline. In 2019, we get the 13 to show up. A few weeks later, we sell off, and it takes several months before we get above. So you had a chance to buy better levels. In fourth quarter 2020, 13, it's just a 2-week sell-off. But again, you have a chance to buy this at 10% or so lower than you did when you first got in. And here we have a signal again. So when you're talking about the QQQ, this NASDAQ 100, the biggest 100 capitalized names in the NASDAQ 100, what this is suggesting is that this may not be the best time to be chasing after growth names. And of course, being that this is the QQQ, these are the biggest names, I would even look at the biggest names within the biggest names, right? So what are the biggest tech names, the biggest market cap tech names? So, it goes, a lot of them goes to your FANG names, your Amazons, your Apples and Netflix and Googles and, did I say Amazon? Not sure if I did. These are the ones that are the biggest weighted names in the S&P, biggest weighted names in the QQQ. And what this is saying is you've got a fair amount of, well, let's just call it higher than normal risk to first put on new longs at this price. Doesn't mean it can't go up and that the signal isn't correct. What it implies is that you've got more risk than you typically would need to take to first put on a long position. So to me, instead of paying 340, what are we at here? 346 and change for the Qs. Not only should the Qs get cheaper, but the biggest names within the Qs should have a sense of a pullback, especially if sometime over the next few weeks, we can get a Friday close that's less than the Friday close from 4 Fridays prior. So right now, this still could imply that we're moving higher, but you can see, for instance, here, this candle, when you close less than 1, 2, 3, 4, so this week it implied that there's still some more likelihood of downside, and you doubled the decline off of the highs just in the following week alone. So again, it just means buying the Qs right now, and big cap tech has more implied risk to it than it does at other times within the uptrend. All right, let's look at TNX. Where TNX, I want to look at First, I think we'll take a look at the daily and then the weekly. All right, so this is actually the 100-day. In purple is the 100-day moving average. We've broken through that. We're beneath the 50. I don't have it up here, but we're beneath the 50. The low this week reached the propulsion exhaustion level of 1437. That's 1.437% in yield terms. Again, this is a TNX, move the decimal over. So something right now, when you see 14.8, that's the same as the 10-year trading at 1.48. The lagging line is in the cloud. It hasn't broken it yet. So you're still in a general bull market for yields, but clearly for the last few months, since topping on that 13 signal, we have gone sideways to lower for the bulk of it. And, there is, if I take the cloud chart off, I can easily draw here a channel. We'll take the highest high, connected here. We'll take the lowest low in between there, and you can see that we're getting very close towards the bottom of that channel. So in an up move that started back in last fall, hold on a sec. So the big move really started, the breakaway move started in January, right? But you had been moving up since October or so. This is really what you call a consolidation pattern in an up move. Doesn't mean it still can't move lower, but the daily chart still implies there's potential down move here to get to the bottom of the channel, but we have already at least reached the near-term decline point for what we'd expect from just over the last week. But I also want to show you the weekly chart. And here again, it's that same type channel. 13 ended up being right by the low. Here's the case why you sometimes really should wait for a price flip, which is that, in this case, close above the close from 4 weeks prior, because we had a downside exhaustion signal here, but you're in the midst of another setup, and it kept going until it finished down its 9 count. And you went sideways, you built to 13 from going sideways, went up, and basically, since getting the setup 9 count, have gone sideways to lower. So right now, there's still a downward bias in this bigger picture. Since we've made the 9 count, we're on a 5 down, which means this week, as of right now, if we closed where the price is, it would close less than the close from 4 weeks prior. So 5 would be versus 1, we're underneath, so it gets 5. If we get a 9 count to the bottom, my guess is that is as low as yields are possibly going to go. That is where I sell out of any remaining bonds I own. And I do think over time, yields are moving higher. They are not likely going back down to where they were last summer or beneath there. So anywhere that we get into the cloud, even especially if we get down towards the TD/ST line at 90 basis points, I will be selling bonds and playing that for higher rates over time. So this to me is the first real move up. This is going to be the pullback, and then we start from the secular lows much higher. Growth versus value. Here's a daily chart. Happen to be right on the 200-day moving average. Notice just by using some, excuse me, mouth is dry. Let me take a swig of water. Here we go. Notice just by using some horizontal lines, we can define support. What used to be support, now resistance. Also, daily 9 high, daily 9 low. We're on a 9 high now against the 200-day. Kind of significant. Makes you think that same type thing. It may not, even though we broke above this resistance level on the 200-day, it may mean that right now, right here, I don't want to buy growth versus value. But let me see, did I put a weekly up here? No. If I flip this to a weekly chart, draw the active trend line, that's broken. And you're through here, and this makes you look like you've got room to go. Plus, to me, the most important thing is look at this double bottom in the MACD that's crossed positively. So if we get a pullback here to support, I'm going to be buying IVW over IVE, and that says growth is overvalued. That means mostly tech still has a good bid to it, and that you're going to want to get exposure that way. Okay, and then lastly, what we're going to do, XLE. So here's a look at energy. This is just the energy ETF. So notice 13 and 9, 1 or 2 weeks before the high of the move, sideways pretty much since February, stalling against the stop out level from the 13. So if we properly close above this and then exceed it by the rules that we have, it would then suggest this goes higher. We still haven't done that. So we're still up against resistance. Now, last week we closed down. This week we're up. If we close above 53.10 this week, and next Monday gaps higher from Friday's close of this week, and next Friday closes above this week's close and above this week's high, you get a new fresh propulsion momentum buy signal with an initial target of 60 to 61. So that's important. I'm taking a little off the table on this rally right now, and I'll see how this week and next week play. Plus, next week, if we close above 55.75, ends up being a setup 9 count, like this 9 count, like this 9 count. Now, this 9 count came in 2 weeks before the bottom. It was a treacherous 2 weeks, but often 9 counts call the turns. So here's a place that I'm really not going to be putting much into the XLE. If anything, I may lighten up a bit. So that's how I'm playing that. And now let's get to our meme stocks. So let's start with GameStop. We're going to pretty much look at weekly charts on all of the stuff. If I see a reason to switch down to daily, I will. Here you can see somewhat of a triangular pattern, right? Equal highs right near 350. You're still on the uptrend. We've even pulled back this week to hold above the uptrend. I don't love the fact that MACD may cross on some further weakness here, lower than the prior one. But if you're playing this, then I suppose from a pure technical view, you're holding support. And for those of you who want to bid for this, you could bid for it. I mean, just take a look on the daily if there's anything. So on the daily here, you can see how 9s can be helpful as well as the 13s. 9 right near the bottom. Oops, 9 close to this top. 9 bottom. 13 on the bottom. 9 up since there. And I pull back to support. So there's support anywhere from 180 to the trend line here 195-ish, give or take, on the daily chart. So yeah, you could take the chance to be a buyer if you think the name's going higher. Let's look at AMC. We start on actually, I said daily. MACD's getting a little cross here from going sideways. Same type thing. There is a triangular pattern here. Let's get to trend in that channel. So all the price action in June has all taken place in between. Let's see. Okay, so here's June 1st. The second day of June was this large range day. Everything's been inside since. So here's your triangular pattern since that happened. And if we do this correctly, then let's see, that line broke. So that uptrend line broke today. I'll change the color of it just to make it stand out a little. So the red line broke today, but there's still a triangular pattern here. Tough what to do here. These names are the type of thing that you have to really kind of try to buy against support. if you like them. If I look at the weekly, I'm not sure we're gonna. Okay, so let's kill the trend lines here, and I see we've got a 9 count. So a weekly 9 up. It's what we call imperfect. We'd like to see bar 8 or 9 be the high of the move. Bar 6 is the high of the move. I'm not going to touch this without it pulling back. That's kind of how I look at this. Blackberry daily chart. 9 bottom, sideways, 9 up. Again, imperfect 9, but it's been pulling back since. I don't really have support down to 9-ish from propulsion exhaustion. We are in the midst of an active bearish propulsion play. So unless I reach a downside target, I'm not likely going to be a buyer, despite whatever we're doing over the last few days, that there's some support. We've got 1, 2, 3, 4, it looks like 5 days with fairly equal lows. There is somebody's buying this, some institution is buying this, but I don't have enough to play against unless you're going to buy this versus yesterday's low. Not strong enough reason for me to touch it. Cleveland Cliff on a daily. Pullback, hit some targets. Let's look at a bigger picture and see. Okay, so nines, double nines mean double 13. So here's the recent 13 pullback from it. Hit propulsion, full exhaustion level. Best thing I see here is that simply there is an uptrend line. There's a channel here, in fact, but again, if you're going to play these names, buy them against support as best you can. So buy pullbacks. You could wait for a move back under 20 here. This has gone nowhere, and there's no way of knowing which way this is going to move next. So rather than paying 21-ish, I at least want to pay against here and realize that this has the ability to easily fall to 14.2 if they start taking meme stocks down again. Here's clean energy fuel. Peaked in February's pullback, got very close to propulsion exhaustion down here 7.5 and moved up nicely. So we can draw a trend line, probably something like this. You got this one broke, and then you can just draw a second one downtrend line here like that. So you're stuck in between here. So obviously, it's better if you can get it down here towards support and a pullback from the level it broke out from. Clover, CLOV. How's that for an upside exhaustion? I mean, there was no signal here. I'm not saying that, but take a look in 1 week, right? It got as high as 28.85. That same week it closed at $15, and it's been down since. Let's look at the daily. Daily's got to a 7, maybe here on a 9 if we get a couple more days of closing less than the close from 4 days back. You have a potential bottom. And we have time for one more. Sorry, we didn't get to all of them. Let me just look through all the remaining names. Let me take Workhorse. So here's the daily chart. Here's the low on a 13.9, rally to a 9 up, pulling back here. It's trying to hold support against a bullish propulsion level. Maybe I do a little light buying here. Nothing. There's nothing big here, but you're mid-range. Better if you get the chance. 962 down to 813. That's the better way. And that's it for this week. We've done a lot. Hopefully you get a little more insight into the meme stocks. I'm Rick Bensignor. This has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.